Welcome to the Flow Tracing Money Audio Commentary. This is Owen Tracy recording. It's 3:25 p.m. that is Central Time, and today is February 1st. And I think the only thing that we could really describe the market as today is a whipsaw. We had a decline on Wall Street yesterday. It was countermanded in here today. We had a good rally in the dollar, and it was countermanded today, so it was down. Then we've had in the oil market, it's been up one day, down the next. It was down today. Copper prices up the last few days, down today. Then within the broader stock market, there were new earnings that came out. Corvo, for example, was in positive territory today. A bit volatile on the day, but finishing on the upper side of the range. That points towards improving demand for components for mobile phones, and they're or I guess it's not so much that they're a big piece of Apple's business, but Apple is a big piece of theirs. So that is pointing towards improving demand, particularly as we come to the other side of the 3-year replacement cycle in mobile phones. And then gold prices, having failed to hold the rally yesterday, followed through on the upside in here today. And I thought that was also quite interesting. We had quite the downward dynamic today in Australia, and that was led by gold miners. They were among the worst performers. And then I think it's reasonable to anticipate that with the dollar coming down today, then that's likely to offer some relief to some of those Australian gold miners. Then when we think about China, we've had a good-sized rally and it's being unwound, and it continues to be unwound. And then there's a lot of discussion going on right now around China and Japanification. And there's, I think, good arguments for thinking about it, particularly with an aging population. And then, of course, additionally, with the degree of leverage that you have within the property sector. But the valuation of the stock market in China is nowhere near where Japan's valuation was in 1989. And I think it would be reasonable to conclude that just on a pure valuation basis, Chinese shares are cheap. There are several companies where they have cash higher than their market cap, and there are plenty of companies that have double-digit free cash flow yields, but people aren't buying them. People aren't particularly enthused for a good reason, and that's because they're worried about politics. That's not something that's easy to put onto a spreadsheet. And you're not going to have a fundamental factor for political uncertainty. And that's one of the biggest issues that China has right now, is that investors have been burnt. They have come to expect over the last several decades that the government would intervene and that they would supply the needed liquidity. But that trend of interference in markets has been ebbing for several years. Then we've also seen within the bond markets that bond yields continue to contract. And this is beginning to price in the deflationary scenario that I've been talking about for most of the last year. So certainly plenty to think about at the present time.